Justin, thank you very much for joining us today. How are things in Southern California?
It's my pleasure. Things are beautiful right now. This is probably my favorite month of the year. As far as weather goes, is June. You wake up in the morning, it's foggy and cold, and by 2 in the afternoon, it's sunny and about 75 to 80 degrees. It's unbelievable.
I envy you. Justin, so much has transpired since the last time we spoke. The first half of the year has been a tumultuous one, to say the least. The S&P is currently down around 15%, give or take. It was down 20%. Bitcoin's down over 30%. Gold is flat on the year, but uranium is still up 15% on the year. Many of the equities are still up on the year in spite of what's happening in global markets, but they are well off their highs. So I wanted to spend some time with you on valuations and how you and your team value uranium equities. But before we do that, why don't we first begin with a brief discussion on your uranium newsletter, which is called Uranium Insider, and just tell us a little bit about that.
Sure. So Uranium Insider Pro is our premium newsletter. We've been doing it since August of 2019, so we're coming up on 3 years here. We've built a pretty significant and supportive community. I have a dedicated small team behind me, including some very experienced hedge fund manager in the resource space. And it's been just a wonderful experience so far. I think that our timing was fantastic in the launch, August of 2019, with the market really taking off in December of 2020. And what we do is we focus really in depth on the macro and the fundamentals of the space. So each month we put out a very thorough newsletter that has, this last month was 40 plus pages, and about 25 of that was fundamental macro information. And the reason that we do that is because the sector is unbelievably volatile, and the movements can be just gut-wrenching in both directions. And it's very easy to get shaken out of an investment that moves like this when you don't understand the fundamentals of it, especially. So if you come in with a vague understanding of nuclear, especially if you're attracted to the space because of the unbelievable positive news flow that seems to be affecting this space over the past 2 years, then you kind of think that things should just move in one direction and one direction only, and that's just not how it works, and that's never how markets work. But there's a lot of speculative fervor that comes in, and then they get shaken out because they don't really understand what's going on. And so we try to take all of the information that's swirling around in terms of fundamental news flow and distill it down into what matters and what matters for investors in the space. And so in addition to that newsletter, we have 10 focus list positions. Our focus list portfolio that's hypothetical, just 100% accountable, and we limit our position sizing. Right now we have 2 half-size positions and also an options position. So we have technically 11 positions, but 10 companies. And so we have our own process for determining the companies that we feel offer the biggest potential in this market for various reasons. So far, we've done extremely well. Our return to date since inception is about 390%. That's down from about 450% at the peak. And we did really well last year. We were up 122% for 2021. This year so far, we're down maybe 5%, something in that range. So really not that bad, all things considered. In addition to the newsletter, we put out a monthly members-only webinar. That's usually about 2 hours long. We have a special guest in each webinar that typically is a representative of one of the companies that we own. That's usually a great experience. We take a lot of questions from our members for that process and get to really geek out and go in depth. And in addition to all of that, we have intra-month bulletins, the emails that we send out as needed based on either breaking news that affects the sector or potentially trade alerts, whether we're trading in or out of new positions.
And I'm curious, your subscriber base, are they based all in the US, Canadians, Europeans?
It's really a global subscriber base. We have the largest percentage of our members is in the US, followed by Canada and the UK, Australia, and then you have Germany, France, Spain, and then from there just all over the world.
That's a great overview. I want to move on now. As you mentioned, you and your team also manage an investment portfolio focused on uranium equities. And given we've seen a significant pullback in global markets, I wanted to provide investors with a methodology on how to identify value in the uranium sector and also prepare for the next big move up. We all know it's coming. So why don't we just start with you and your investment criteria. What exactly do you look for before you make an investment?
Sure. Well, we look for liquidity, first of all. We look into management pretty in depth. We like to understand the capabilities and prior record in terms of what management has accomplished with previous companies or with this particular company in the past. We like to see a decent amount of skin in the game for the insiders at the company. We look at the share structure very closely. That's something that I think is really important, especially with the smaller and mid-cap companies. Share structure is something that most retail investors overlook, and that can drastically affect the way that a stock moves. So, and of course, we look at jurisdiction. Jurisdiction is very important. Jurisdiction can make or break a company. We like to own companies that are in jurisdictions that at least have some history of previously supporting uranium mining. That's pretty crucial. We don't really like to make bets on jurisdictions, even though a jurisdictional bet can potentially pay off huge if you own a company that's in an iffy jurisdiction and then they get approval, then you can see explosive moves, but the opposite is true as well. You know, there's very few things that can really cause an investment in a mining company to tank severely, if not go to zero, and jurisdiction canceling of a project is one of those things. So we don't like to gamble. Just generally speaking, we don't like to gamble. We like to bet on primarily developing companies that do already have some type of positive looking asset or assets that have the potential of getting into production in a reasonable time frame. Those companies typically get some sort of re-rating by the market when they near or start to actually go into production. And especially a company that maybe the market doesn't recognize as a potential producer and they move towards that production during a bull market. We love those types of stories. So yeah, it's the asset, it's the management, it's the jurisdictions, it's the share structure, primarily those four things. And we give those different weightings depending on the company and depending on the jurisdiction, et cetera.
So let's dive into each of those elements. And why don't we just start with your portfolio of 10 names. And if you look at it from a producer, developer, explorer point of view, what would be the breakdown between those three components?
It's primarily developers for us. So producers are typically, I mean, there's so few producers. I mean, there's just a couple of names that you can buy that are actually producing anything at all. But developers, I think, is kind of the sweet spot. If you own explorers, it's probably wise to diversify greater than we would like to. I think that there's a sweet spot in terms of diversification as well. If you diversify too much, you might as well just own an ETF. And the potential for outperforming that ETF, if you're diversified pretty much like an ETF, is pretty much zero. And so, but at the same time, if you under diversify, you expose yourself to pretty significant individual company risks. And so that sweet spot for us is 10 positions, and that's worked out well for us so far. Explorers just have much more risk, and they of course have more upside potential. You can find a small exploration company that makes a discovery during a bull market, you can have explosive returns. But again, that tends to be somewhat of a gamble. You can reduce the risk of that gamble by understanding geology, by speaking with the actual geologist that's working for the company, by recognizing what they've done in the past. There's a lot of explorers in the uranium space and in the metal spaces, just generally speaking, that just keep a drill turning once or twice, every single year, and they raise money every single year, and the management keeps getting paid, and the insiders keep getting their options, but it doesn't really do anything for shareholders over the course of a decade or longer. They just keep poking holes in the same ground, expecting different results, and so you have to just be wary of that. I think just taking a shotgun approach is not the way to go with explorers. I would, if it were me betting on explorers, I would drill down to maybe 5 different explorers and take you know, a 20% position in each of those explorers. In terms, by 20%, I mean if you were to allocate 10%, like our focus list portfolio, into a single company, I would allocate you know, 2 or 2.5% to an explorer, and not go much higher than that, because the risks are there that they just keep, you know, they just keep drilling and find nothing.
And you also mentioned jurisdiction is very important to you. What would be the top 3 jurisdictions in the world for uranium mining?
Top 3 would probably be Namibia in Africa, Saskatchewan, Canada, and perhaps Wyoming in the United States are probably the top 3. Obviously not a lot of uranium being produced in Wyoming, but it's a very, very friendly jurisdiction for uranium production. And the companies that are producing even, you know, just a few thousand pounds at this point, they are based in Wyoming in the States.
And they also have strong support from their state government.
Very strong, yeah. John Barrasso, the senator in Wyoming, has been a staunch advocate of nuclear and of uranium mining.
Justin, I want to ask you now about valuations and how you value a producer versus a developer versus an explorer co. Do you use a net present value formula, or do you look at pounds in the ground, or exactly what methodology do you use?
Well, for producers, you know, like I already said, there's only a few companies that are actually producing. So you can actually do forward cash flow, you know, discounted cash flow models for producers and come up with a relative valuation number, which is perfectly useful for a company that's currently producing, you know, and you can actually look at their current cash flow and expected cash flow. The problem with that type of valuation model for developers is there's so many variables that are nearly impossible to estimate at this point, to the tune that that type of valuation model is almost useless for a development project. You know, even you can take a company like, let's say, Global Atomic, for example, who did a PEA recently last year, and they were coming up with their expected forward cash flow based on $35 uranium. Now we're already at $50 uranium, and it's less than a year later. What are we going to be at the time that they come into production in terms of the cost of that uranium and that they can get on the market? In addition, what are we going to see in terms of their capex costs due to supply chain problems, due to inflation, due to the cost of diesel fuel, et cetera, et cetera? Those types of models are, in our opinion, almost worthless when it comes to development projects. So in order to gauge a valuation, you almost have to do it on a relative basis from comparing companies to each other, rather than trying to get, you know, an NPV or a forward cash flow on a company that may or may not ever actually produce. Even the development projects, it's like, okay, everything looks rosy on paper, but as you and I both know, you know, mining is probably one of the hardest businesses in the world, and actually going from finding a deposit, which is hard enough, dealing with all of the red tape to actually produce a you know, a fissile mineral out of the ground, that radioactive element, it's extremely difficult. It takes a very, very long time, and there's unbelievable hurdles. So to expect that that's going to happen without running into problems is naive. But with all of that said, you can at least take relative valuations from company to company and say, okay, well, you have this many pounds in the ground, you can expect to be producing this much uranium. If we value uranium at the same price for both comparative valuations, then you can say, okay, this company is undervalued, this is overvalued relative to each other, without knowing, okay, what if these guys are able to sign contracts $80, $90, $100 2 years from now? What does that look like to their bottom line? And now how does their valuation look relative to where they're at now? So that type of valuation is useful. You can also look at historical valuations, okay? So just to put some perspective, Cameco, no, let's look at Denison here. So Sprott put out an analysis of the uranium space in 2007. This is February 2007. This is 4 months before the peak of the market, okay? So Denison Mines, they were just over a $2 billion market capitalization at the time. And they were trading at, and this is an EV to pounds in the ground. So their enterprise value, their market cap minus cash plus debt relative to their measured and indicated resource. So not even just like the proven out 43101, but measured and indicated, okay? They were trading at $21.42 per pound. That was Denison. How much were they producing at the time? Zero. They were not producing any cash flow at the time, and they were trading at 22 bucks a pound, okay? Then we'll take another company. I'm not gonna say who it is. This is a development company. We actually own it. They are actually currently cash flowing. They have a pretty good resource. They expect to be producing uranium in 2025. They're trading at $2 a pound in the ground right now. And so that the pound in the ground valuation is iffy at best, but you can at least use it to make a relative comparison between companies and between now and the peak of the previous market. So if that gives you any sense of how crazy valuations can get, then there's some significant upside potential still in this market, in my opinion.
I'm glad you brought up the Denison valuation from 2007 because I want to ask you about that last cycle. And when you look at it, this cycle compared to the one we saw back in 06, 07, when uranium got up to $150 a pound, what's the big difference?
The big difference between the two cycles?
Yes.
Oh gosh, there's quite a few differences. I would say the biggest difference right now is that we actually do have a supply deficit that didn't exist in the previous market. The previous market ran up for a couple of reasons. There were a couple of catalysts that led to potential supply disruption. Those were primarily floods at both Cigar Lake and McArthur River. And then you had financial speculation that came into the space and really moved the price up. So the utilities at the time never really ended up paying more than $100 a pound. And there were a couple of utilities that did sign contracts around that $100 a pound mark, and they never lived it down. You know, it was almost a career killer. And so the utilities have a memory of that, and that's one reason why they haven't voluntarily stepped up to the plate over the past few years, even with this supply deficit current and looming going out in the future, to sign contracts at a higher price than what they could get through carry trades and spot market and buying from the Kazakhs, et cetera. So that's kind of the biggest difference, is we actually have a significant supply shortage right now that will slowly be reduced with the restart of both McArthur River and Paladin's Langer Heinrich over the next 2 to 3 years. But then from there, the alligator jaws widen again, and it goes back to a potentially severe supply deficit out towards the end of the decade. So that's a really big difference. Let's see, another big difference is we have a large idled fleet of nuclear reactors in Japan that is set to come back online. So that didn't exist back in 2006, 2007. That was mainly a China growth story and perceived supply interruptions that really moved that market in the big way. Once the commodity started to recover to a relative, that marginal cost of production level, which at the time was probably in the 50s, beyond that was all supply shock and market speculation. And so now we have this fleet of 33 reactors. 10 have been restarted, so there's another 23 reactors that can be restarted in Japan in relatively short order. That's a big bump in demand that's potentially near term. That Japan is wanting to get to 20 to 22% nuclear by 2030, which is another 20 reactors restarted. And so we're seeing now the new president of Japan come out as a vocal supporter of restarts now. Japan they don't have a lot of natural resources. So all of their energy output, they have to import coal, they have to import natural gas, they have to import uranium. The big thing with uranium is they still have a decent amount of inventories. So the utilities that do still have reactors that can be brought back online have some fuel that they can utilize going into those reactors. And B, uranium is so unbelievably concentrated that for Japan to have a 20% of their grid go back to nuclear, they can store a decade's worth of energy resource in a single warehouse. It's so concentrated that it really makes sense for them. So that's a really big difference. And then of course, SPUT is probably the third thing that's the biggest difference. It's a physical trust that's run by the player in the resource financial space, and they have an ATM. And so now you have this vehicle that financial players can can own uranium without having to hold uranium on their books by owning trust units in the Sprott Physical Uranium Trust, have exposure to the commodity. It's highly liquid. And when the trust is trading above 1% to premium to NAV, half of the money coming into that thing is going to buy physical uranium. So it's a pretty unique setup across the board.
But when you look at this cycle compared to the last cycle from a valuation point of view, there's so much more upside associated with this market that we find ourselves in right now, even in spite of what's happened here in the last few months.
It's true, yeah. So at the peak of the previous market, it topped out at about 140, 150 billion market cap, something in that range. And right now we're right around 30 billion. To give you another relative valuation metric here, this also came from that Sprott document from 2007. So 2007, February, Cameco was at 16.6 billion in market cap. They peaked out at 24 billion. So they made a move from 16 billion to 24 billion in 4 months. That was that last big leg of the market, right? So if you adjust for inflation, 24 billion, that's about 29 billion right now. Cameco currently is sitting at about a 10 billion valuation. So for us to even go back to that type of level, we're looking at a potential, 3x in the largest cap company in the space. So if the large caps can do a 2 to 3x, the mid caps can do even more than that. The small caps, who really knows? It's kind of the sky's the limit. On top of that, we have a backdrop that's unbelievably positive for re-embracing of nuclear. So that's kind of unique. There's this upswell of positive sentiment, not only because of concerns about climate change and decarbonizing grids, but also just the energy crises that's hitting the entire world right now, and that's only getting worse. So that's underpinning all of this. And then you just look at financial markets and look at the money flow now compared to 2007. It's got to be 2 to 3x in terms of the actual amount of money that's swirling around the world in institutional in investment markets. And so the potential to breach that 150 billion market cap is definitely there. And it all has to do with how much we're going to see a rotation of money from overvalued tech growth stocks and into value stocks and commodities. And we're only a year and a half into that rotation. These commodities runs, they can last a decade. So we're still potentially in very early innings for this thing.
Well, that's good news. Justin, I want to thank you for making the time today. It was a great overview of what's happening within the uranium sector. It's always very enlightening when we speak with you. I would remind our viewers to check out Justin's website and YouTube channel, Uranium Insider, and also his newsletter. There's a link below. He provides a daily update on what's happening in the sector, and I would highly recommend it. Once again, Justin, thank you.
My pleasure, Jimmy. Happy to be with you again.